All right. Good morning, everybody. Green on the screen, and it continues. We are starting to see the NASDAQ pick up a little bit. Last week, it seemed to be dragging its feet with the S&P doing more of the work than the NASDAQ. Hong Kong down 0.5% still implies that those China ADRs still are not in play. It's just too soon. There's a lot of stimulus that they can still do, a lot of arrows in their quiver, so to speak. And the big event is in March of next year. So it's worth continuing to keep an eye on those to expect, a continued distribution before the start of the accumulation phase as we get into December, January. I know it goes against everybody's obvious reluctance with the tariffs and everything, but that's the obvious reluctance, right? If it was that easy and if it was that simple, then new people who, don't know how to trade at all could just listen to some news about tariffs, come in and start trading the market thinking that they can just short China because of tariffs. It's not going to be that simple. It's not going to be that easy. And we still expect the China ADRs to do well as we work through 2025. My bet is that it's going to kick off before March, right? They'll start accumulating before then, and then March triggers it, and we get into like stage 2 in the Wyckoff kind of classic model. Japan up this morning, more than 0.5%. Looking really good over there. The crazy thing is, if you look at the carry trade this morning, it's really pointing to the downside. And I was kind of stuck on this a little bit. We know that we're going through a change. And so we're going to see, the dollar doing things different. We got bonds closed today for the holiday. So, things are going to be a little off. But we got the 2-year up, the ES up, the dollar up, the carry trade down. Now, something on this chart is wrong. One of these are lying to us. We're either going to see that 2-year fall, we're going to see the carry trade rise, or we're going to see the ES fall, and possibly the dollar fall with the ES. Something's off here, right? One way or the other, something's got to give. A lot of focus still on small caps. But we've been waiting for the small caps play since they started cutting rates, and we're still waiting, right? When it comes to how much more we could get out of small caps. As I've mentioned a while back, if you look at, say, IWM at 300, that's been a call that's, been in play for a while. And I'm still on the sidelines. 300 by the end of the year was the call back in like January, February, March, right? Somewhere in the first quarter, that was the call, not mine. And back in March, I mean, it certainly didn't look like we were going to see IWM at 300. Now, I mean, we're moving in the right direction. Let's say it that way. So small caps up more than 1.25%, while we have the NASDAQ and the S&P more in line today than we've seen them in a while. Just like last week, the volume is a little off. With the bond market closed, expect that maybe some of the tools that we generally look at aren't going to behave the way we would expect them to. and we don't have really big economic events on the table today. So a lack of, call it, stimulus, a lack of galvanizing news or any other event, lack of volume, and a broadening out of what we started to see last week, we can continue this move. There's no reason to think that it's done yet. Although just this morning, I did stumble across something on chips, because like right now, chips are a part of the biggest threat to the market. All right. Mainly NVIDIA, but chips in general are one of the biggest threats to the market. So if NVIDIA misses its earnings, then the whole show is over anyways. But we've focused on the Trump trade, the Biden trade, the Harris trade. Did you catch something in there that you didn't hear probably recently? The Biden trade. The Biden trade is the chips trade. Yeah. So that's something to be focused on. It's easy to overlook that because we were all focused on Harris, but there was the Biden trade. All of his policies and initiatives that they were doing to boost the domestic industries and the domestic infrastructure for chips, for AI, for the data centers, all of it. That's all a part of the Biden trade. So we're going to need to see new policies, new procedures, new proposals at the very least to get that out of one space and into another space. Chips are driving this market, right? So if we lose that and we start to see more pressure on chips, right now it's still just coming back to NVIDIA. It needs to have a really good earnings again. And how many times can it have not just good earnings? It's got to have like blowout wow earnings. It can only do it so many times. We did see Bitcoin run over the weekend, and that is another signal of risk, right? That risk appetite is here. Bitcoin also connects to semiconductors, right? To chips. I have a watch list that I put together, a couple of years ago that focuses on crypto. It's from a basket from the Smalls Exchange, from Tom Sosnoff's little group, his crypto Smalls. So if you opened that basket of stocks up, what you would have found is things like AMD, PayPal, Square, NVIDIA. I mean, I don't know about you, but those aren't the names that I think of when I think of Bitcoin, right? When I think of crypto, and not those. So with crypto up, we want to continue to see that integration. We got NVIDIA more than a half, PayPal 1.5, Square 2.5. It's looking good. Riot 11%. Coin 16. Mara almost 17. Little bit of a blow off top kind of look to it, right? At that point, it's getting to be a bit much. So we got a lot this morning that makes us believe that the drive from last week isn't done. And I think the more people that try to come in and short this thing because they think we've gone far enough are going to contribute to the buying when they get squeezed and have to forfeit their position. We do have a gap that needs to be closed with the call wall right in the middle of the gap. I have the gap highlighted here. 60.32 is the upper edge, is the cog line. And then Friday's close around 60.23. So that's the gap. All gaps fill eventually, someday. And then we've got an inside day breakout. So we want to watch to see this call wall get rolled today. Keep our eye on the options structure because we're through it. And that doesn't mean that they have to move it, but it's the expectation that they would move it. The thing is, we're close enough to the third Friday. That's where OPEX is at, right? The third Friday of the month is options expiration. So got to kind of figure, why would they go through all the effort to roll it if they're going to need to manage it at the end of the week anyways? They may just keep that call wall in place. So we want to see if they're going to just do some hedging activity, or, what are they going to do with this? Since we are up, we're closer to the upper edge than we are the lower edge. We're not close enough yet to expect gravity, but inertia is a word that applies to the market quite a bit. If we're moving to the upside, the expectation is that we'll continue to move to the upside until something changes, i.e. we hit something, or we get data, or the market opens, or something, right? So base case argument, as long as we're moving in this direction and we can get through that 60-50 options level, then we should continue the move to the upside. So if we turn on, some structure here, 60-50 options level, and then we got OCC at 60-52. We got a voodoo line at 56, and then we got the ADR half at 60, call it 61. If we break back down inside of Friday's range, then we can turn on something like the 786, and that should line up with the 60-32 cog line or the call wall, something right around in there, right? That should be the 618 or the 786 area. But if we come back inside of yesterday's range, my trade is to take us back to the gap close. So, we're just headed to Friday's closing price. We are back to a 1% ADR. If ADR confuses you, just use the ATR. It's the average true range, average daily range. Really, there's not much difference except the math. This is what the market does on average. I'm using a 21-day, which is a market month. So, markets generally don't move in a straight line. They go up and they go down. So on any given day, if the average range is 1%, then we could move up 0.5%. We could move down 0.5%. So, say we closed there, the next day we opened, we went down 0.5%, we went up 0.5%, and then we closed up here. But we fluctuated, right? So that's what price does. So ADR, average daily range. What has the market done over the last month? It's moved about 1% a day. If we get really bullish or really bearish, we'll move the entire 1% in one direction, all the way up, all the way down, right? Like one of these really big blowout days where we opened and we have almost no wick on the bottom and we just ran in a single direction all day long. So far, that's what we have with today's candle, right? Almost no wick, ran in a single direction, still pressing against those highs, 60-50. Today's floor pivot is higher than yesterday's floor pivot. That puts us in a bullish posture. Price hasn't hit the pivot yet either, and price opened above the channel. So all of that is bullish. There is a consideration for an MDP, although technically we did tag it, right? We tapped that level. But I would say that in the spirit of it, that's still an MDP. That's a missed daily pivot. So Wednesday, Thursday, Friday, and now today, we have not hit that pivot point. We're going to continue with this bullish bias and this bullish posture until we definitively take one of those pivot points out. And I mean, this can be interpreted as, yeah, we tickled it. How about we break through it and close underneath it? Well, now you can't really argue that we didn't hit it, right? So until we do that, this bullish bias is going to continue. I can't see any reason to change my mind and start talking bearish until at the very least, we're underneath that pivot point. The week's pivot point, 59.29. Let's just round that up to 59.32 cog line. If we can get bearish on the week, we could potentially look at some short trades for all the overbought stuff that's out there. But until then, I wouldn't expect all that overbought stuff to fall back. We really don't have much out here on the profiles. We can see that if we fall back to 60.32 area, we've got a lot of structure back here. But we didn't bring the point of control up. We left it behind. It's way down here at 57.50. So not much. It's not going to be much help if we do fade back. We can see a little bit of structure at the round number 6,000. But if we break this low, 59.92 cog line, then it's game on to retrace at least half of last week. And then we'll see, right? That would be like the first target would be half of last week's range. $58.82. And then we'll see. Ten-day, 30-minute volume profile with TPO. Their point of controls are nearly overlapping, and there's no reason to believe that we're going to move the point of control in our direction anytime soon. One, we would have to stay in a particular spot long enough to build one of these levels out. Two, unless we do that, as we lose this volume here through the next day or two, the point of control is very likely going to shift down farther away from us, not closer to us. Same thing with the TPO on the other side. Looking at the 5x5, we carried that POC from the other day, just seeing how it was going to interfere with price on Friday. You know, it got down in there, it hit that 92 cog line, and then we flipped really nice off of that level and came back up, but it didn't line up really with the POC. It lined up more with the cog line. Either way, it's just a level to mark. But Friday, we did get a VPOC, so we're going to add that to things. 60.22. So if we fade to the downside today, that's a level of interest we want to pay particular attention to. If we were to just mark the RTH halfback, it lines up at the same spot anyways. So either mark it as a VPOC or mark it as Friday's halfback in the RTH session. That is double confluence, right? Or just confluence. Has two levels of structure there laid on top of each other. You got to love it when things just come together, right? So if we are looking for a little bit of weakness or a pullback in digestion, which would be healthy, right? Say a little bit of like this that we did on Friday. Well, it would make sense in that pullback to come down into the 60-22 area. Makes sense to me. We need a little bit of digestion, right? It's not a bad thing. All right, Friday morning, we measured this range and it was pretty narrow at the time. Well, it's more narrow now. So this projection of last week done, this is what we actually ended up with. This is a very narrow range. I got to caution against this range simply from the fact that there's two ingredients that make these lines. All right, one of them is time and the other one is volatility. We put those two things together and we get our range for the week. It's the weekly expected move. And generally speaking, we'll close inside this range 70% of the time. It's a 1 standard deviation measurement. But volatility, when we're looking towards an event, volatility will get suppressed, like FOMC, CPI, non-farm payroll. Those events suppress volatility. So when you see this range really narrow, it's not because we're in a low vol environment. It's because the market is looking forward to a really big event and it's expecting them to go sideways into that event. Now, we've seen this setup before on, say, FOMC week. And on Monday, we're like, oh, yeah, Wednesday's FOMC. We're likely going to just go sideways Monday, Tuesday, part of Wednesday. And then on the very first day, on Monday, we run all the way to the edge. We get to the entire week's expected move on the first day, up or down. Well, one of the reasons for that is because the range is so narrow, we're able to get to it really easy. Two, it's a lack of participation. If there's not a lot of people trading, then it doesn't take much to move price. So while the base case argument, and we do have some big events on the horizon for this week, the base case argument is we're just going to continue this drive to the upside. Unless or until we get news that changes everything, I would expect the move to continue. We are 3.57% away from the 10-week. This isn't as extreme as it sounds. We've been higher than that before. So just stop my mouse there. You can see plenty of times that we've been higher than this. We're still in the sweet spot, so to speak. But once we get into the 4.5 area, then we're going to be looking for some reversals in the market. They could come now. There's no reason to say that they wouldn't. Just don't look at this and think, oh, yeah, we're crazy overbought. We've got to fall. No, not yet. Now on the 10-day, rather than the 10-week, we've been higher than this before, but we're getting into the levels of concern. A really good analogy when you're thinking about overbought and oversold is picture a runner trying to go up a mountain, all right? The higher he goes, the harder it is to run. And along the way, you add more weight to his back. He can still run, right? You didn't break his leg, knock him down the hill. It's just going to be harder for him to run. So when we get into these overbought, oversold levels, it's not to say that price can't continue to move in the direction that it was already going, just that it's going to be a lot harder at that point. But if the drive is still there, it's going to keep going. So we're a little stretched on the daily. So far, we've still got the drive pushing it. Bitcoin, 7.5%. Banks, 2%. Consumer discretionary, 1.75. The Mag 7 group, 1.5. China ADRs, 1.25. We've got the drive, right? Even stacking more weight on the back of that runner, there's still a lot of drive here. It's got heart. We need tech, finance, and consumer discretionary. Those are the three risk-on sectors that we have to have a rally. We've got all three of them. All three up more than 1%. My benchmark at 7:30 in the morning is 0.5%. If you do this same scan, say at 9 or 9:15 in the morning before the open, your benchmark should be 1, maybe 1.25. We're already there. We've got that all the way across. There's no reason to believe that this rally is done. Gold miners down. I'd like to see a little out of bonds. And we got semiconductors down this morning, at least on this one. When it comes to pre-market stuff, always double check SPY, Thinkorswim, because Thinkorswim can act a little goofy, especially on a Monday morning. It doesn't do good with morning stuff anyways. So let's look at the down names, see if we can spot bonds again. There's bonds. We're still inside of Friday's range, but we closed at the highs and, well, we're testing the intraday lows. So bonds down and semiconductors are down. At least SMH is. Broke below Friday's low. Now we've got an algo print showing that it's trying to come back up again, but as we've talked about before, those little algo prints don't mean nothing, right? We need to see some real flow, actual candles showing up in there. When we look at it on the daily, we can see the resistance that we hit. We formed like this little misshapen cup or bowl. Maybe this is just a handle on that bowl, and then we continue the run to the upside. Maybe. But to even consider that, we've got to get back inside of Friday's range and then get outside of the week's range on the other side to the upside. So we don't want to see semiconductors down, right? Now, it is just SMH, which is an ETF. And if we open that up, it's likely that we'll find one or two really big semiconductor names that are down, not the whole group, right? Because if we flip things around and we look, at individual names, say like NVIDIA, yeah, it's up this morning. As long as we've got, a couple of big names moving on the other side of it, all's well. That's a really big Bitcoin move. Pot stocks are up, small caps, China ADRs, financials, more pot stocks. So everything's looking good. This is a rally that's broadening out, which is exactly what we want to see, right? We don't want another year on the back of the Mag 7 group, right? So keep your eye on banks, consumer discretionary, and the Mag 7 today. If we start to lose those, then it's likely we could stall out and stop running higher. That's not the same thing as falling, by the way. We can pause at these highs without giving any back. If you're looking for a flip, I gave you the level you got to get underneath, right? If you're going to look for those short plays, get underneath the week's floor pivot. Be careful, be safe, watch the clock. Not a lot of news today. It's going to start getting some of that tomorrow.